So let's look at the long-term trend as we look at every month. Um, it's positive, barely slightly positive. This year's been very odd so far. I mean, December finished pretty strong and then kind of flattened out, and then it's been little dodgy here so far this year. But it's not terrible just yet. So let's go into why. So as of right now, the long-term trend is positive. It's very lightly positive at 0.17 is not a big number, so I'm not super confident in where we are right now. This is the past 6 months, so you can kind of get a feel for where things have been. Like this last run in October, that was a fantastic run. And then it's been a lot of iffiness. And below this line is usually kind of a danger signal for the market. Right now it's above, it's not above by a lot, but that's where we are. Midterm cycle, which we do a lot of our trading off of, our cyclical trading is still positive. Midterm cycle is 163 positive. It's not super positive as it was back in the end of the year. It had a good run in the year and then it kind of came back, but we're still positive. So that means money is still flowing into the market. It's when that goes negative that you want to have a little bit more caution and ease on your investments. So we're still positive and it's not terrible, not strong, not bad. It's been weakening, but it's flattened. So just kind of a neutral, no real strong opinion other than a slightly positive bias from here. And then how does that relate to the market? So as you saw, when this was the big jump here, the big jump in the green corresponds to this big jump here, and then it's just kind of flattened. And the market started the year, right, it was down and then up. So we had a buy signal back here. So we've been up and then down and back up. So we're kind of flat on it. So I'm not too concerned at the moment. We're still doing okay, but the boxes are when we're out of the market, when there's higher volatility, right? So when the red line goes up, there's higher volatility. Green means there's lower, and that's usually a run. Really, since December, it's tried to go lower, and it really can't seem to. That makes sense. So we're watching that. I'd love to see volatility relax a bit, and we could have a good run up from there. We're set up to do that, so I'd like to see that follow through. But you never know, and things are odd. Last year or so. Sectors are still positive, 5 to 6. It's really about the same as it was last month. It's not hugely changed. It's still nothing really to report. It's a very mixed bag. Energy and financials are the stronger side. Real estate and utilities are the weakest. Although oddly, a couple of weeks ago that was very different. Things shift from day to day to day from what's strong and what's weak. And it's been fascinating to watch. So whatever's good today is probably going to be the bad thing tomorrow. And it's been doing that day after day after day. And it's interesting to watch. You probably shouldn't, I don't recommend it. So what I really wanted to get into is the inflation rate. And this is kind of something that's should take, you should make a lot of note of and see where we are and what how the Fed reacts to this is what we should be thinking about. So the US inflation rate is currently 6.81. That is a high number. We have not been that high since the 82. We came down to that at 82 and we started to shoot up with that in the 70s. So if you recall this period of high inflation, that wasn't the greatest for the stock market. It was very volatile, big swings up and down and whatnot. So as we've talked about, valuations are overvalued as well. I don't have a chart of that this month. I may next month, but valuations are high. And just like it was in 2000, and this is the second highest it's been in recorded history. So valuations are not great for the market, but if the market wants to go up, we're going to let it and follow it. And that's why we show you the midterm cycle and the long-term cycles. And that's money coming in, and you don't fight that. As long as money's coming in, you're still okay. Now what really has us, on our seat, the edge of our seats is what the Federal Reserve is going to do this year, right? Are they going to raise rates? The consensus is anywhere from 2 to 4. I've talked to many people, many economists, many fund families. They're saying somewhere in that range. I think it needs to be on the farther end. I think it needs to be closer to 4. However, the faster they do that, the more volatility we'll have very quickly into the market. So, we need to take our medicine, but it's going to hurt at first. So I think that's what we're coming into. And they've said they're going to. What's been fascinating is the market has been ignoring every Fed minutes that come out in the last year, except for the last week. And they said, we're going to raise rates. We've known that for a year, that they have to do this at some point. And this is what it fights inflation, is raising interest rates. So So suddenly the market seems to care more than it has. It's been ignoring this news for the past year, and now it seems to is taking notice. So we'll see where that goes. And then finally, we talked about how I've talked about this a lot last year, and I think this visual was amazing. Advisor PJ had this morning on an email I had, but the majority of stocks right now are not going up, and they haven't been. And this is giving the illusion that the stock markets are healthy and positive and good, but only about 10 stocks of the S&P 500 are really the ones driving everything because their valuations are just so big. And that's the Googles, the Netflix, the Facebooks, the Teslas. Their valuations are so large, they make it look like everything is fine. When really underneath the surface, we've got a big problem under here. A lot of stocks are going down. We're just not seeing it. So there's not a lot of places to be other than those big names. And if those big names start to have problems, then we're going to see it ripple through the market.